Is there a non-trivial risk that the RBI could supersize this rate cut this week and go for a 50-pointer?
Right. So our view is of a 25 basis points rate cut on Friday. The situation where the RBI could consider a 50 basis points rate cut is if it thought that it could deliver more than 50 basis points in the cycle further, which means that the total amount of, or the total quantum of rate cuts in the cycle would be in excess of 100 basis points. Our view is that the RBI will cut twice more, once on Friday, 25 basis points, follow it up with another 25 basis points. So unless they really have clarity on easing more than 50, doing a 50 basis points easing on Friday seems unlikely to us. If you just quickly look at the growth inflation picture also, while inflation is low currently, GDP growth number, which came in last week, surprised consensus to the upside. And therefore, that growth inflation mix might also prevent them from going for 50.
Exactly. And 7.4% really surpassed expectations, doesn't it? So do you feel that on balance, Santanu, this week's decision by the RBI and any clarity that they give us in terms of forward guidance is going to be largely neutral for Indian bonds, the rupee and stocks?
Well, the market is pricing in a little over 2 rate cuts from here. Remember, in India, financial conditions ease not just through the repo rate channel, but also through liquidity. And the RBI, apart from easing repo rates twice already by 50 basis points, has done a great deal on easing liquidity. It has been through a combination of OMOs, through repo operations, through FX swaps. And effectively, in our view, the RBI has delivered more than 100 basis points rate cuts already, just with 50 from the repo. Because if you look at the overnight rate in India, it was trading at around 690 in mid-January, which is now around 575 or 580, which is about 20 to 25 basis points below the repo rate. So from the market's point of view, as long as liquidity is easy, they will perceive this as a guidance for further easing if they deliver 25 basis points and keep the guidance dovish.
Understood. Santanu, can I circle back to what we were discussing earlier, and that was Friday's Q4 GDP print, 7.4%. Do you feel that the RBI this week, on balance, is going to look through the seasonality that was associated with that number and the one-offs relating to a spike in tax revenue? Or is it going to be a consideration?
So there are 2 ways of looking at the growth numbers in India. One is GDP, which you correctly pointed out, got a boost from the net indirect taxes. It was more than the tax collection. It was more the subsidy payout was lower in that quarter, which sort of boosted the net indirect taxes, which got GDP number to 7.4. But remember, on the supply side, on the production side, GVA, or the gross value added, also came in above market expectations at 6.8%. That is a pretty solid number. The RBI will, in our view, take note of that number, which means that you've already met the 6.5% CSO, or the Statistical Office's advanced estimate target, and this will be pretty good from the RBI's point of view. In terms of going forward, the one-off that you really had in that quarter, in our view, was the government capex. That came in very, very strong. It was backloaded. So effectively, the economy got a fiscal impulse, which was positive in the back half of the previous fiscal year. That, in our view, will not sustain in the first half of the fiscal year. But we are still looking at a number north of 6% for the year.
Yes. Part of this feel-good factor associated with the Indian macro and the market's narrative really seems to be down to benign inflation trends. We're looking more favourable because of the monsoon rains. I was speaking earlier with a guest on the programme about renewed confidence amongst the rural consumer. Does this all point towards inflation expectations being far better anchored than they were before? Or is this all lulling us into a false sense of security on the inflation front?
No, our view is that inflation, after a long time, will remain benign, at least for the next couple of quarters. Especially food inflation. You pointed out a good monsoon and a good crop. I'll just point out that the winter harvest, we are being told, is quite good. So if you have a good winter harvest and then you have a decent monsoon, which means that the summer harvest also can be good. Broad-based, you'll see better production and therefore lower inflation. The part which you cannot really forecast is what will happen to perishables or vegetable prices or let's say fruits. But even if you bake in some spikes in those items, we think that inflation will remain around, the headline inflation will remain around 3.5% for the rest of the calendar. Going into the next calendar year, the first half, is where we again see inflation going back towards 4% and thereafter 4.5% as you head into Q2 of the next calendar year, given the very low base of this year. But I would say that inflation is low for the next couple of quarters. That we are also seeing as a real income boost, especially for the rural economy and the mass consumption.
That said, Santanu, let me present the counterfactual. Are there signs of household debt becoming problematic and perhaps putting the brake on consumer spending?
Household debt was elevated last year already, but we do not think household debt has gone any further higher. Remember, the RBI came in with macroprudential tightening on, especially on consumer credit, in November 2023, and thereafter throughout 2024 you have seen consumer credit growth come off from about 25% odd towards early double-digit numbers. So overall credit growth from the banking system has come off from about 17% towards 11% or so. That has reined in the build-up that you are seeing in consumer credit. So the unsecured segments have already been taken care of from the macroprudential tightening. The question is whether you can get credit growth accelerate towards what you had in the 2 years back. We don't think you're getting there, but we think that the peak drag from credit that you had is already behind us.
I wanted to ask you about that, but just before I do, liquidity is getting to the parts of the economy that need grease on the wheels, are they, Santanu? And can the RBI afford to step back, or do they have to keep up the liquidity provisions on that score? And just give us a bit more colour on credit growth and the velocity of lending and whether it's consistent with headline growth in the region of 6.5%.
So firstly, on liquidity, as I said earlier, the RBI has done a lot on liquidity already. We don't think that they need to do more right now, either in terms of OMOs or in terms of repo operations or FX swap operations to inject liquidity. And the reason is because they have paid out a sizable dividend to the government. It's 2.7 trillion INR, and that was in line with our expectations. That will come through into the banking system and keep liquidity conditions benign for the next few months. Thereafter, in Q4, if required, our view is that the RBI will inject further liquidity. Remember, for monetary policy transmission in a cutting cycle, liquidity needs to be benign, such that the overnight rate or the effective rate of transmission of monetary policy is below the policy repo rate. So that's on liquidity. On the credit, we look at it from a more holistic point of view, which is the overall credit in the system, which is both banks, bonds in the onshore market and offshore bonds. I would just say that given the tightness and liquidity conditions last year and the macroprudential tightening from the RBI, you had a lot of NBFCs and corporates go to the offshore market to borrow in dollars. We see some of that trend probably changing with domestic conditions becoming benign, and some of that borrowing will probably shift to the onshore markets.
Can India stick with the narrative of fiscal discipline and continue to target fiscal deficit of 4.4% of GDP for the current fiscal year? And what potentially could challenge that? Could it be a commitment to increase defence spending, given what we saw with the flare-up between India and Pakistan?
We have seen India sticking to the fiscal consolidation path over the last 4 years or so post-pandemic. And every year, the government has over-delivered on the fiscal consolidation by anywhere between 10 basis points to about 30 basis points. We think that going forward, they will be able to consolidate the fiscal deficit by 40 basis points from taking it from 4.8% of GDP to 4.4% of GDP. If there's incremental spending required on the defense front, our sense is that it will be more of reallocation of capital expenditure that will go into defense rather than increasing the deficit to meet the defense spending targets. But at this stage, we feel that the government will stick to the fiscal consolidation path and target 4.4% of GDP.